rather than selling the asset or looking for other ways to mitigate taxes and things of that nature, if it's that mansion cabin home that's been in the family for 5 generations, you want to just leave it in the family for another 5 generations and not sell it. Well, the deferred sales trust, in order to be eligible, you have to sell. There has to be an eligible transaction where there's at least $1 million of potential taxable income coming to you that you're going to make capital gains on. And so those are a couple examples of when it's not a perfect fit, right?
Perfect, Jake. Yeah, thanks for sharing. And then we're going to share my screen real fast. So this is kind of ones we've touched on. Again, the asset does not have $1 million net proceeds, $1 million gain. You have a good investment, 1031 into, and you want to you have also a carry forward loss to offset the capital gains tax. You might have that, so you want to check with your CPA. You may have sold something at a loss. To touch basis, or to, I guess, the other part of it to add on the stepped up basis, that's definitely important. But what if you have an estate that's greater than 24 million? You're married, or what if you have an estate that's greater than about 12 million and you're single, and or beyond, but basically 2026, end of 2025, that is going to cut in half. And so you might have an estate tax problem. So who is it not for? You don't have a 40% tax challenge, estate tax challenge, right? You have carry forward loss. You have a good investment at 1031 into. Maybe you, like Jake said, you want to spend all of the funds all on personal goods all right now. So you're selling a, $2, $3, $4, $5, $10, $50 million worth of assets, and you said, I just want to spend it all on personal stuff right now. Well, that's not tax deferrable. Now, could you earn interest on the trust? Yes, and that trust repay you back on that interest, and then you pay tax on that amount, and then use that to buy personal goods, of course, because it's after tax dollars, right? So realize that you can still purchase personal stuff. It just can't be in a tax deferred state. So you can go buy that Lamborghini or that Ferrari or that boat or that travel that you want to do. It's just going to have to come from the trust to pay you immediately at close or over time, and then pay tax on it and then do that. And then again, the fee is about 1.5% one-time upfront fee on the gross sales price, and then basically up to $1 million, and then anything above $1 million, 1.25. And then the recurring fee is 1.5 to 2%, including the financial advisor on the net proceeds. Now, if the deal does get larger, and if, there are larger opportunities, that does go down. But we're just kind of giving a general rule of thumb there. That being said, some other reasons why you might be reluctant to use the deferred trust, or the downside. I think one of the downsides that comes up is, who is this trustee, right? And I can't imagine sleeping well at night knowing that it takes his signature for things to move, whether that be investments, whether that be for paying fees. And it's interesting that you can have all of the control, but that doesn't work for tax deferral, right? So what's interesting is, even in a 1031 exchange, if you think about it, you're giving up that control for 45 days or 180 until it goes into the next property. So our instinct, and we get where everyone's coming from, this is probably the number one objection, is, oh my gosh, I'm working with a third party trustee, I'm having to give up control. Now, we have some tools and some ways to mitigate perhaps some of your fears or concerns with that. But the very essence that you don't know the trustee previously to your transaction, that's our rule, is just to earn and build your trust to be able to perform that service, is the very reason we can actually use and you qualify for the deferred sales trust to keep that tax deferral. So what are some of those tools? What are some of those legal frameworks that we put in place? Well, one, there can be like a trust protector. And so a trust protector is sort of like a boss to the trustee, in that there's certain things that they can do to make sure that the trustee is doing his or her job, right? And so that is something that we can put in place. Now, it does cost more, and it would be increased cost to the trust, but that is something you can put. You can also put a co-trustee, right? Now, it's important to understand that that person needs to still be a third party, but at least that co-trustee could have certain like authority, like, for example, investment authority to sign for that, whereas the other trustee could have for paying the fees and monitoring and making sure the tax return is properly filed. And so that can create some additional, comfort, right? So, Jake, can you want to add to any of those things that I just talked about there?
You know, I had that exact concern this morning, actually, about an hour ago, with a rather nice client, potential client named Joe, who has 3 rental properties that are highly appreciated that he's owned for a long time. There's no longer any debt on the properties, anything like that. Purchased them literally 200,000-300,000 each. Now they're worth over $2 million each. So he's an older fella. He's owned them for a long time. And a couple different things. He asked, well, can't I just go to my local guy that I've been talking to about a living trust and have him take care of this? And then another question he asked is, this trustee, you're saying I can't do anything, without talking to the trustee, or like the trustee can do whatever he wants with all of my money, and so those questions right there, Brad, I mean, what would you say to him at that moment?
Yeah. So also to realize that nothing moves without your approval as the creditor, right? So you're lending the trust. And so think of it like a bank, but a bank will loan you money on your house if you didn't have fire insurance, if you didn't make the payments on time, a B, there wasn't a clear title, right? In other words, they want to make sure that their investment by loaning to the funds is going to get a return, and they have the rights and protections of a lender. So you have all the rights and protections of a lender, and you have the ability to foreclose. You also have the ability to approve or disapprove of the investments. And prior to anything being set up, there is a risk tolerance questionnaire that you're going to take, and we're going to work with you to build out a wealth plan, in which Jake Miller, financial advisor, to build out a wealth plan. And that's the key here, right? It's a team approach. But if you had unilateral control, it would be taxable. And yes, the trustee does have to approve of the investments. But if you think about it, I say choose your control. Let's imagine it's a $10 million exit and you have $4 million of tax. $4 million of tax is deferred. That's the government's money. It's just in a deferred state. The other $6 million is yours. And so the control could be, I want all unilateral control of my $6 million post-tax, or I'm going to give up some control of my $6 million along with the other $4 million of the government's money so we can build the wealth here. So that would be the first response there, Jake, on that. How did I do?
I like it. In addition, that you're not all that bad of a guy. It's important that people actually have a chance to meet you and to greet you, that they come on this panel discussion every Friday, that they can see how you interact with other people. They can hear the stories of after the fact. One of the other common concerns that is raised is that, hey, once this is all set up and done, does everybody disappear? And so that they can hear and see that through the stories that we share here on this call, that we don't just disappear after it's all set up and done. And people get paid and they go away. That's not our MO. We continue on with the clients. We help them, we guide them, we direct them, we give them options, we let them know what all their options are. They want to do something new. We guide them through the structure of what would be most optimized. And at the end of the day, we all become friends. And that's kind of more sentimental than anything else. But it's important that people know and understand that we work with people we like.
Yeah, that's a great point. And it's really what we're building is a family office or like a dream team around or with your existing dream team, right? To help you build your wealth and make an impact for your family and for the things that you believe in most. And by the way, that does mean sometimes there's different options. Like I said when we kicked off this call, it doesn't always have to be the Deferred Sales Trust. It could be a donor advised fund. It could be a charitable remainder trust. It could be buying real estate via 1031 exchange and doing cost segregation. It could be cost segregating existing deals that you have to offset your 1031. It could be a mixture of a Delaware statutory trust to replace some debt over basis, or just to go into that as a way to diversify away from the Deferred Sales Trust. All of these have their pros and cons. And the key is, what's the best fit for you? And so if you're listening to this, the biggest thing is to say, where am I trying to go and where am I at now? And then work with us and we'll clarify the options that you have. And we'll give you our best recommendations, but ultimately it's your choice. It's your money and it's your future for your wealth. And we would love the opportunity to earn the right to be good stewards along with you, to manage the trust and to help you fulfill the goals that you want. What are some of those goals? Well, there's some freedoms. I call them maybe 10 freedoms that come to mind to start. Kind of already talked about the freedom from the 1031 exchange. That's kind of one of them. We already touched on the estate tax freedom. We can eliminate the estate tax. But there's also like location freedom. You might have a business or an asset in a state in which you want to relocate to another state. And And but what's tying you there is that asset or that property or that business. You might want time freedom. In other words, that asset that you're managing now, that business you're managing, is taking up a lot of your time and your energy, and you're looking to retire or become more passive with your time. You might also be looking for increased cash flow. A lot of our clients, before they meet us, they're real estate rich, or even their business is just through the roof on valuation, but the cash flow is maybe not as heavy, or it's kind of pretty light. And so able to capture or reposition that wealth into a place that can produce cash flow and more immediately. Another freedom would be partnerships. We had a deal, $13 million exit in San Diego for 4 partners. One wanted to pay the tax. The other 3 wanted to do what's called the Deferred Sales Trust. And so they each had their own trust. They also wanted to pay off some debt, and they didn't want to be stuck in a 1031 exchange during the time frame about a year ago when we closed that asset. And so it could be a seamless partnership separation. It could also be a freedom from the C Corp, a massive tax above and beyond. Typically, if you're in California, even beyond that, 30, 40, even 50% range. I've seen as high as 67%. And so you're saying, wow, I got a lot of benefits with this C Corp in the beginning, but now I'm about to get hit with even more tax. Is there a way to get some freedom and flexibility there? The trust can solve that. It also works for short-term capital gains tax. So you might have bought something that's less than 1 year old, and you're looking at a way to defer the tax. Guess what? Deferred sales is going to give you the freedom from that short term. We did over 37 million of exits in Texas last year for our client who shared a story on our YouTube channel. And for him, he had hold less than a year, which means he doesn't qualify for the 1031. He's able to use that. So those are just a few of the freedoms. Rebecca, what freedom most sticks out for you, what we talked about, or just in general for the Deferred Sales Trust?
The time freedom away from the 1031 exchange, especially the way the real estate market is going these days. It just allows people the time to park the money and think about what they want to do. They don't have to act immediately, and diversify if they want to. Anyway.
Absolutely. And to your point, right? Rebecca and her husband, they build custom amazing homes in the Lake Tahoe, Truckee area. And then she also sells them for her clients. And so I'm curious, Rebecca, what are you seeing up there, right? And what would it have meant for some people who perhaps maybe should have not, not 1031, right? Because the adjusting of interest rates that have happened over the last 7 months.
Yeah. So an example from last year, I know some people who were in the process of selling a business that had some real estate tied to it, and not knowing about the Deferred Sales Trust, they tried to sell the business separately and the real estate separately, and then they were tied to having to find a piece of property really quickly with the 1031 exchange, and there just wasn't much out there, and there still isn't much inventory out there to identify those 3 properties and find something that you're actually going to get an accepted offer in and close in that time frame. So lack of inventory, and then interest rates are higher, so you want to sit down and wait a little bit until maybe the interest rates come down a little bit.
Yeah, and last week, well said. Last week, it seems like they felt pressured to overpay. Maybe they did, or maybe they ran out of time. And now perhaps they might be in a position saying, "Oh, I wish I would have known about it." And that's most how people find us. Either they're in that 1031 or they're about to be, and all of a sudden they go, "Wow, there's actually something different here." In fact, last week we talked about why the DST was made for times like this, but we'll just reiterate kind of what we talked about. You can go back and watch that mastermind. Essentially, you don't want to be in debt. You don't want to have adjustable rate debt that's going to be going higher here soon. You want liquidity, you want diversification, and the Deferred Sales Trust delivers on all of that. Whereas a 1031, you have to buy of equal or greater value, you have to take on equal or greater debt. And if you've done that and you're in an adjustable rate position, you put yourself in a very weak position. Should you have too much debt, and should that debt be adjusting? There's not a cap on that. And so that's a really important thing to consider when you're looking at your plan. The Deferred Sales Trust delivers. And I want to bring in Pierce York. Pierce York, they're in Newport Beach. Pierce, what most sticks out to you about what we've been talking about so far?
Hey, Brett. I like all the freedoms that you get, but I do like since Rebecca took control of the timing, which I think is probably one of the most important. I do like the freedom to go into other assets while you wait. So, I mean, even with the 2% fee, you could throw it into treasury bills right now and still earn a guaranteed 3.5% on your money. And that's just locked and loaded. So you don't have to go into just one asset class, unlike a 1031. You get to diversify out. You get to be into multiple different things. And then when the time's right, you can go into real estate again or that new venture or whatever. So I really like the freedom to maneuver and diversify.
Absolutely. Well said. I want to encourage and invite, we have Mr. Tucker here. Mr. Tucker, I'm curious, A, where you're from, B, what questions or thoughts do you have so far? Nice to meet you too, by the way.
Yeah, likewise. I appreciate what you guys have shared thus far, and it's good insights on all the above. I really do appreciate it.
And where are you calling from? I'm curious.
I'm actually in Utah.
Yes,
All right.
Ryan. We've met before. My goodness, I didn't recognize you at first till I heard your voice.
Been a little bit, Jake. Yes, but we have.
Yeah, my goodness, how are things now there in your new home, your new I believe RIA and all of that other stuff?
Yeah, all the above. Things are good, man. These are good. It's been about 6 years, I think, since you and I actually first talked, believe it or not. But fun to circle back and see you.
My goodness, how time flies. No, glad to have you here on the call. Should there be specific clients or client examples, I mean, redact their names, whatever, we're more than happy here on this panel discussion to talk about cases. In fact, that's kind of like the segue of where we're going to go next, right, Brett? We're eventually going to talk about a couple of deal stories of the week or people that we've helped or are helping or in the process of helping, or just share past successes that are also good stories to share that help us relate to other people who might be on the call or people who view the videos, that they can relate to real life examples and how it might work for them. Some people, we get a lot of stories of like, well, we hear, is this just for real estate? Or is this, I mean, there was a period of time when we were doing a lot of videos on cryptocurrency because that was a big thing and everybody had highly appreciated crypto, right? And so for everybody, there's an instance. In fact, just the other day, we had a call with a guy who was just barely as separating from Apple as their chief financial officer, and only around 30 million or so in possible Apple stock, and how he loves Apple, never gonna sell all of his Apple stock or anything like that. But at the same point, it represents 2/3 of his net worth, and that's a little bit out of equilibrium of where he feels he should be. And so, how does he effectively reinvest that into other assets? And we discussed the Deferred Sales Trust with him. So just a lot of fun things like that.
Yeah, very well said, Jake. Yeah, let's share a few of those deals. Here's one in San Francisco. It was a duplex, and a couple clients of mine, they had a dream of moving out of the city and moving to Hawaii. And this is a couple of years back, so they sold it at a great price. They lived in half of the unit, and the other half was rented out. So they had some of the half of the property with the 121 exclusion, and the rest of it was subject to huge capital gains tax. So they sold the asset. This is what it was right here. This is another one. This was in San Diego, just a regular house that we did for a client. We have this one. This is in Palo Alto. This is about an $8 million deal. It's a primary home. Seller wanted to move to Nevada, relocate. He wanted retirement freedom, location freedom, and really just to pay off a lot of the debt that he had on the property. So that was a big one. Here's another one in Cruz, Aptos area, just south of Santa Cruz. And that was about a $7.9 million asset. And she was in her 70s, and actually her son is a financial advisor. And so he was doing all the due diligence, and he's in California, and as you can imagine, making sure that we are who we say we are, the things, the investments are going to be appropriate, and all of those things. And so, yeah, he gave the blessing and checked with the CPA after probably about 3 or 4 months of due diligence, and he used the Deferred Sales Trust. His mom did, and he's the trustee of the estate. And then in Placerville, this was Warren and Catherine. Warren just shared his story about a month ago on our mastermind, which is pretty cool. And they were driving 4 or 5 hours some of the weekends to manage the property. He's like, why am I doing that when I have 2 twin daughters? They're 10 years old. I can be spending time with them. Why don't we sell, increase our cash flow? And they did just that. And so, yeah, the list goes on and on and on. What we really like to do is just spend time with each individual who might be considering the deferred sales trust, talk about the downsides, talk about the upsides, talk about the risks. As far as the legal risks, sometimes those things do come up. And the question is this thing legal? Does it work? Well, so far, it's always worked. It's worked 1,000% of the time over 27 years. There's over 24 no change IRS audits. So far, so good. It's based upon about a 1920s, 1930s tax law, which is known as an installment sale. And it continues to serve people in all 50 states and all asset types. So yeah, we're excited to tell you about that as well. So all that being said, where should we go from here, Jake? Any other thoughts, questions, comments? Even Ryan too, if you want to.
I think just talking about time framing is helpful. I think, you know, for proper expectations, it's good and it's nice to know that we've together, Brett, done a deal in as few as 3 days. But that's not the norm. In fact, we prefer to get in front of a deal 3 months ahead of time, just depending on what the circumstances are. And, you know, is there a letter of intent? Is there a buyer lined up, or are there at least conversations going? Sometimes we get in front of a case even when a person's thinking of selling for the first time, but we don't really have to do much other than educate until we get closer to that sales deadline. Maybe if you can add a few more points of processes and steps that we take with people, Brett.
Yeah, so the timing is really important, and ideally we're with you before you even list the property. That's ideal. Why? Because there's different parties that are going to be involved in the escrow, the listing, your CPA, the M&A attorney, the business broker, all of these parties that are involved. We want to make sure that we are properly setting expectations and clearly weaving in as smoothly as we can into the transaction. So that's ideal. Now, practically speaking, most of our deals we're finding out 21 to 30 days before closing. A lot of times it may already be in escrow, or there's an LOI on the table. And so we're hustling to make sure that we are providing as much as we can. This is part of why we're creating this content. If you're watching this at an opportune time, out of the normal hours of the day, so that you can get to know, like, and trust us and the strategy and the process. And so what it looks like, essentially setting up a trust. Prior to setting up that trust, you sign a conditional engagement agreement. That conditional engagement agreement is 100% conditional. So there's no retainer. There's nothing that you pay us or the tax attorneys who create that. And you pick a name of a trust, we set up a trust, and we weave a language into the purchase and sale agreement that essentially you have the option to exercise to use the trust should you want to do that. And then you can continue on with your due diligence, or the buyer can at this point on your asset that you're selling. And as well, you continue your due diligence with us, getting to know us, talk with our clients, and talk with banks, financial professionals like Jake. And then if you want to use the transaction, use the trust, you can. And if you don't, you don't. If your deal isn't closed, no problem. And that's when we get paid, is upon the close of escrow. So we want to take that pressure off of you. Realize that we're here to give you recommendations based on your unique fact pattern. And that's kind of the overview. Jake, anything to add there? Or Pierce, anything to add there? Looks like you might have something to say.
I like how there's really no risk for you up front. I mean, at the very least, right, you get to talk to one of the smartest, tax attorneys on the planet, and just explore the options, right? Even if it's not for you, at least you have the option available. And I think that having options, especially in today's landscape, is just critical.
Yeah, very well said. And then, of course, once we invest the funds, Jake, there is some risk. So talk about the investments and how it might differ or be the same. But if someone shows up and wants to invest with you, how are we going to figure that game plan out, Jake?
Well, typically, just the nature of investment speaks that there is something at risk and there's something at gain. And so ideally, we help mitigate a lot of the risks depending on the person's risk tolerance and what their hopes and dreams and objectives are behind the investment. But one of the main qualifying features of people, whether or not they should or should not use the DST, is that they're hoping to reinvest. That might be in real estate, that might be in marketable securities like the stock market, that might be in another business through a joint venture with a trust, a lot of different ways to reinvest. And so we take people through a little journey, Brett, with the corpus of the trust, meaning what do they want to do with all of the assets inside? And some of their goals might be to reinvest in real estate, but it might not be until the next deal comes along, and the next deal might not come along for 2 or 3 years. So then that means that they have a short-term time horizon for the assets until that next deal comes along. Not only do they have a short-term time horizon as an example, but they need to be able to exit within a range or a period of time without the market being down or without selling at a loss, so that they can reinvest in that next big deal that they've been holding out for. But in the meantime, they're taking advantage of something better than the bank. Meaning right now we have a lot of people in this type of scenario in treasury bills. We have a lot of people in a top 40 dividend preferred stock portfolio. We have people in a lot of different portfolios based on their needs and objectives and what they hope to accomplish over time. And it might be that, hey, I'm going to need this money for 9 months. We might align them with a short-term bridge loan that they can do for somebody for 6 to 9 months, where it's collateralized and guaranteed. And they can do that with their trust. And then again, there is a need for a certain amount of liquidity within the trust so that we fit within the guardrails of what is appropriate, because there's this promissory note associated with the trust. And we need to be able to show the IRS at any given time that they have the ability, meaning the liquidity, to do a distribution for at least that promissory note payment. So there's a lot of different features that we manage and massage. And essentially, Brett, this is not the job of just financial advisors, but more of a corporate asset manager that we actually, Brett, you and I, we actually assist a number of other financial advisors, some with their own business cell, in this type of structure, where myself or somebody else like me steps in and assists them, even though they're financial advisors, but we help them with their portfolio. We take obviously into consideration all of their comments and all their requests. I believe that we met with one that we even looked at their preferred portfolio and we tweaked it a little bit to align with what we gave as recommendations. They accepted those and we moved forward. And that's what we do. We're all a team. And sometimes we're called the dream team, or we're just the team. We step in and we help the people make better decisions. Like I always say, conscious, deliberate decisions where there's a reason and a because behind everything that we do.
Very well said, Jake. And yeah, I couldn't agree with you more. And we're here for you and to help you out. And we want to earn your right to be a part of the dream team, or the A team. Wasn't the A team, right? What you had?
Am I supposed to have the mohawk if I'm on the A team, or which?
Yeah, exactly. Maybe. So we want to become the DST A team for you. But in all seriousness, we want to be able to work with you and talk with you and see if it could be a great fit. Rebecca, I want you to touch on to see how do you save a failed 1031 with a DST? Do you remember how to do that? I want to see where you're at with that. And then how do you use it for a primary home?
Okay. Well, gosh, I'll start on the easy. Well, how to save a 1031 exchange. I mean, if the property is already sold and it's being held in a 1031 exchange company, I believe that we can still take those proceeds and put it in a deferred sales trust and add that so you're not tied to that time frame.
Yeah, you got it. Yeah, so if the funds are already with the QI, right? You haven't taken constructive receipt. We can basically from the QI go to the deferred sales trust. Now, to mention it to everybody, you want to make sure you're working with a qualified intermediary that is a part of the outer team strategic alliance that understands how to do this, because not every QI company knows about this or knows how to do it. So you want to make sure that you're working with the team that can accommodate, and we have that. So come to us and we can make sure to connect you with them. Great. Now, by the way, it needs to be on either day 45 or day 180, and there's lots of strategic timing associated with that. So make sure you're with us early to time for that. Now, how do you do it for a primary home? Let's imagine you have a $10 million home in the California side of Tahoe, right? That someone's owned for 30 years, Rebecca. They bought it for $550,000, right? And now it's $10 million. So what would you do to help them get going on the deferred sales trust to defer the tax?
Sure. So, I mean, even if they use the 121 exclusion, they're still out almost, $9 million. I mean, $9 million of that is probably going to have to be, taxed.
About 33% of it, which is about $3 million of tax, right? If you just said $1 million was the basis and $9 million was the gain, about $3 million of tax. Keep going.
Yeah, so they can utilize it, and sell that, that primary residence. It just, if they don't need the money for another home, let's say they have a second home, or they're just going to rent or travel around the world or whatever. I mean, all those proceeds can go into the deferred sales trust.
Yep.
It just needs to get set up ideally before they list the property, but before,
the buyer removes all contingencies, right? And make sure
Thank
escrow
you.
knows so they're not freaking out at the last minute, right? So we want to work prior to, right?
Yeah.
And then now, Rebecca, what if they want to buy another primary home with some of the proceeds? Is that okay?
Sure. I mean, they can do that. That portion will be taxed.
Right.
That portion will be taxed.
So say you said a $10 million, asset, and you said, I need at least $3 million for a down payment. You can take that and pay tax on that. So you have $7 million, and you're still deferring some tax, right? It's in proportion to what you received. In that scenario, maybe you're deferring around, $2 million of tax or so, right?
Right.
And if that the ratios make sense. And so you can have you still have your 3 for the down payment, and then you could have 7 in the trust, which is still an extra 2 of tax you would have paid, because you basically probably paid about $1 million on the other one that you took out. I have to do the math, but you get the point, right? So you can have flexibility. So you can have your cake, but you have to pay tax on that, right? And then, but you can also have the tax deferral on the other part. Pierce, you want to add anything to that, or what are your thoughts? Like, let's say you're selling a luxury property in Newport Beach, where you're located as a real estate professional. What do you think on that, Pierce?
Yeah, and I think it really depends on your goals too, right? As you touched on in the beginning, like sometimes the personal use, case is better. If you want to travel around or buy a primary home, like, okay, maybe just it's not for you. However, what I do like is the ability, as long as you get with us first, right? There are solutions to all the problems, in my opinion. And there's different ways to structure things. For example, maybe you could do a cash out refi on, your home. If you've got it paid down and you have $1 million basis, and you put maybe 500 into it, you got a 1.5 million you could pull out tax free, right? And then when you go to sell the property, okay, now you have 1.5 million that you can use as a down payment, and then use the cash flow off the trust, right, to pay the note. So my point to all of that is saying there are a lot of creative ways that things can be structured, and I think the key is getting with us early so we can x-ray your deal, look at what your goals are, and then we can make suggestions and align those two based upon, different strategies and stuff.
Yeah, you nailed it, right? And just to reiterate what Chris is referring to there, essentially you can do, when you do a refinance or cash out refinance, that's not a taxable event. And so to the extent that at the close of escrow, your debt is equal to or below your adjusted basis, you're in a great position. So we can defer all of the other tax, as long as you've just been taking straight line depreciation, or if it's a primary home, for example, you essentially didn't do a massive cash out refi above your basis. So let's do an example to keep it really simple. Okay, so imagine you own a $10 million Newport Beach house, and that basis is $2 million, right? $2 million. You bought it for about $1 million, and you put about $1 million of improvement into it, and or your 121 exclusion combined makes it $2 million. And let's imagine you owe no debt. The way we would structure this, if we have enough time, is we would say, hey, look, you want to do a DST? Yes, great. Do you also want to maximize your tax-free money? Yes. Do you want to decrease some of your DST fees? Yes. Great. Here's what we do. On that, we do a cash out refi up to $2 million essentially. So go get a loan up to $2 million, pull that out. That is tax-free at this point. So now you owe $2 million. Immediately list the property, sell it. That $10 million buyer that comes in is going to pay off $2 million of debt. You still have the $2 million in your bank account tax-free, and then $8 million is going to go into the DST, tax deferred. Okay, and so you're going to have $2 million of cash sitting in your account. The $2 million that you had borrowed is now paid off, and there's $8 million sitting in the deferred sales trust. In that scenario, you're probably deferring at least like $2.5 million or so in gain, or in tax. You have an $8 million gain, and that's a great way to get a little bit of best of both worlds, where you can use that $2 million for the down payment on the next one, and you still have that tax deferral, and you decrease your overall DST fees because you're only being charged on the recurring fees, at least the 8 million that's in there. Jake Miller, do you want to clean that up or bring a little bow to that at all?
I think just high level, we are very, very transparent about all fees and about all actions that we take. Depending on the level of trust with the client or level of experience or just history working together, et cetera, sometimes we have quite the discretion. But even with that discretion, immediately when there's a transaction, immediately when there's a fee, everything is sent to the client. Occasionally we have a meeting to update them with everything that we've sent them if there's any questions. I kind of just want people to know that nothing's ever done in the dark. We're always working together. People are fully informed, and that's why we're still in business. And that's why we're not just still in business, but we're growing and helping more and more people every day.
Yeah, it makes sense. And by the way, you have 24/7 access to view funds online, like at TD Ameritrade, Charles Schwab, where Jake clears investments. Same thing with the bank accounts that the money goes to. Same thing with the tax reporting. You get to review the third-party tax preparer who's looking for any inconsistencies. You get to review those tax returns. So you have all of that. It is your money that's owed to you, and we're here to serve you on that front. So that being said, we're basically, I think, I feel like we did a pretty good job. Pierce, you want to add anything else, or Rebecca, or what are we thinking here?
No, are we to questions yet? I have a couple of questions.
Yeah, Rebecca, go.
Okay. So I was talking to another agent. He had listed a multi-residential property in the area and zero basis on this property. And I was like, oh, and it's listed for just under $2 million. I'm like, oh, well, your clients might be appropriate for this. Apparently they're a nonprofit, and that nonprofits, when they sell, don't have to pay capital gains.
Right. Correct. Yeah.
Is that true? That
Yes,
would be
true.
true.
It's kind of like, and even like church, like a church organization, like charitable, right? Nonprofits. Yeah, there's certain exemptions that are not subject to capital gains tax, and so nonprofits is one of them for sure. So that's good for them.
Good to know. And then the second one I came across, the gentleman said he had an irrevocable trust set up already, and that so if he sold property, the proceeds would transfer directly through his kids, and he didn't need a deferred sales trust. So
yeah, I don't know the full story there. So an irrevocable trust in and of itself does not provide a trust in and of itself doesn't provide tax deferral or capital gains tax deferral. It's the installment sale, which is part of IRC 452, the tax code, and following those procedures, coupled with the trust, that actually creates the tax deferral, right? And so when he's referring to irrevocable trust, he may be referring to his living trust, which means it passes outside of probate to his children.
No, I understand that. I have one of those.
Yeah, you have one of those. And so I think that would be the next question to say, okay, so, clarify, are you saying that you're not going to be subject to capital gains tax? And you would say, yeah, that's how I understand it. And you'd say, what is the tax code that you're using to be able to defer? And you might say something like a 401k or an IRA or a 1031. Those are all part of IRC tax code 1031, IRC tax code 401k, right? It's specific code, not just a trust. And so that would be the question to ask him. And go, oh, that's really interesting. Let me learn more, and then see what he says what tax code is. Does that make sense? And by the way, did an attorney set that up? Was it a CPA? Did a CPA review it? Just because some people get confused, right? And they might be confusing the stepped up basis with it passes to my kids with the stuff. Yeah, if you die, right? But if you're selling it before you die, then that doesn't kick in, right? It has to be death, right? Is that making sense, Rebecca?
Yeah, he definitely used an attorney for whatever he had set up. So I definitely need to ask more questions. But yeah,
that's great. Good questions. Anything else more, or any other ones?
No, just those two lately. So,
is the market you feel like heating back up there in Tahoe, Truckee, or is it?
Yeah, I think it's heating back up. The weather is gorgeous, so people are actually able to get here. So it's good. We're still dealing with a lot of people. Most of the buyers come from the San Francisco Bay Area, from the Silicon Valley area. So there's been a few layoffs, and people are a little being conservative right now. So I know big part of our market is second homeowners. So they're just taking a step back. But the people that have money still have money and they have cash. So they aren't necessarily as concerned about interest rates and those kind of things for mortgages.
Good feedback. And Rebecca, if people want to find you, where can they find you if they want to check out these houses?
Right now, RebeccaMunson.com is probably the best way to reach me. It has access to my cell phone, direct to me, and emails, all that kind of stuff. So.
Awesome. Connect with Rebecca if you're looking to buy or sell any property in Lake Tahoe or Truckee, especially luxury real estate. Jake Miller, if people want to get in touch with you, where can they find you? You're on mute, so I'll pass to Pierce while you unmute. Pierce, if people want to find you, where can they find you?
You guys can find me at kingdomluxuryrealty.com and Living in Newport Beach, California YouTube channel.
That's awesome. Thank you, Pierce. Mr. Jake Miller, where people want to find you, where they can find you?
Absolutely. So we have a website, strategictaxsolutions.com, and an 800 number, 1-800-773-1848. Happy to help.
Amazing. Thank you, Jake Miller. And by the way, if you want to read Jake Miller's chapter, I just released a book, and Jake is a part of the book along with Kevin Harrington from Shark Tank. It's called Building a Capital Gains Tax Exit Plan. We're proudly to announce we hit #1 bestseller in real estate and wealth category. Pretty cool. It's on Amazon right now. And it's my journey and a lot of other people's thoughts on business, real estate, investments, the Deferred Sales Trust, all in the book. Pretty cool. Check it out. And if you want to connect with me or one of my team members, you go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. Thanks so much, everybody. And we'll promise to do better next time. Bye now.
Bye.
Recording stopped.